Hello and welcome to this presentation, Speculating with Futures. In this presentation we're going to look at the way in which it's possible to make a profit by correctly forecasting how the spread relationship between two or more futures contract months behaves over time. This is sometimes referred to as future spread trading or basis trading or calendar spread trading, and in some quarters it's also referred to as switch trading. So suppose in this example we expect the spread between two different futures contract months to narrow over time. How might we trade this view? Well, suppose we can represent this price relationship as shown here. We can see that the March futures contract is trading at $50 and the June futures contract is trading at $60. Suppose we think that the June price is likely to fall, for instance, and maybe the March futures price is likely to rise. What we could do then is buy the March futures contract and simultaneously sell the June contract. And if indeed we are correct and the price curve now ends up where March rallies to 55, and similarly we can see that the June contract has fallen, in this case to 55, then we would make a profit on the trade by simply now closing out the two futures legs. In which case what we need to do is simultaneously once more, in this case sell the March contract at 55 and the June contract buy at 55. So if we look at the March legs now, we originally bought at 50, we close out at 55, so we'll make a $5 profit on the March leg. On the June leg, remember, we sold originally at $60, we simply buy back at $55, and in this simple example, we'll also make $5 on that leg. So overall, we've made a $10 profit on the trade. So this is an example of how we trade the narrowing of the price relationship between two futures contracts. Notice, of course, what we saw here was a sort of pivot around the middle of the two futures contracts, and the spread as a result narrowed. But it's also possible, isn't it, that we could have the March futures contract stays exactly where it is over time, and all that happens is that the June futures price ends up completely flattening at around 50. We would still make a profit on this trade. We'd also make a profit, of course, if June stayed where it was and the March futures price ends up rising. In other words, once more, the spread is narrowing. And indeed, we can see that if March actually gets higher than the June price, we'll also make money. In other words, if it inverts. So actually, we can see here that there are many different permutations, many different ways in which the spread can work to the spread trader's advantage. Of course, it's possible to lose money on this trade, and we can see how this is possible, because if the March futures price actually falls and the June futures price rises, then of course we'll lose on both legs of the trade. Let's now turn our attention to another type of spread where we're going to look at spreading between multiple futures contracts. What we're going to do now is to look at a variation on the calendar spread that we've just seen. Suppose here we have the price relationship where March is trading at 50, June futures at 60, and September futures are trading at $70. Suppose we now observe the following, where the June futures price rallies up to $72 and March and September prices remain the same. Now we may just think that this is a temporary blip in the market, and very soon the June futures price will end up falling back down maybe to $60. So we could simply do an outright trade and sell June and end up buying it back later on at $60 and make a profit. In other words, this is an outright trade, but it is quite risky, because what we might actually be witnessing here is the early stages of a parallel movement in the price curve where September and the March contract, as we saw, are moving upwards. So we end up with this parallel movement in the price curve. So with this knowledge then, maybe what we could do is consider a series of spread trades, in which case we could think about buying March, as we saw earlier on, and selling the June contract. So we've just got on here a simple calendar spread, but not content to do just one calendar spread, we could also trade the September June spread. So once more, what we need to do is to sell June and buy September. So let's just see what happens then if the June futures price simply falls and everything else remains the same. Notice we've sold 2 June futures, so in a falling market we'll make profit. So that's one outcome in which we would be profitable. Another outcome in which we'd be profitable is if the June contract remains where it is and we get a parallel movement where the March contract price rises and at the same time the September futures contract price rises. So we end up with this sort of parallel movement. We could also make money on the trade, for instance, where the March futures price maybe rises a wee bit and the June futures price comes down to sort of meet it, and maybe at the same time the September price also rises a little bit. So we end up with a sort of parallel movement in the price curve, but not as high as in the previous example. So we can see again here with these types of spreads that it's possible to make money in a number of different sort of outcomes. But also it's worth noting that we can lose money on this trade, because if the spread relationship ended up doing this, where the June futures price continued to rally, and we saw maybe the March futures price fall, and at the same time the September futures price fall, then of course we'd end up with a considerable loss on our books. So just to summarize then, spread trading with futures enables us to take a view on the sort of predicted change in the shape of the price curve, and it allows us a number of possible trading outcomes where we could make money. But of course we mustn't forget that it's also possible to lose money on spread trading as well, as illustrated.